welcome you with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Morgan Stanley says it prefers Dalal Street over Chinese equities, upgrades its rating for Indian stocks while downgrading China. Says it considers India to be on a path of long wave boom. There is even more good news as S&P Global projects India's economy to grow 6.7% every year on an average for the next 7 years. Says India's GDP to reach $6.7 trillion in 2030-31. Infrastructure and manufacturing are the big boosters. Markets continue their fall for the third straight day. Sensex down more than 1,200 points in 2 days. Follow global cues which continue to remain weak after Fitch downgrades the US. Adani Group consolidates its cement business. Ambuja snaps up Sanghi Industries for 5,000 crore rupees. Sanghi hits the upper circuit for the fourth straight day with the open offer expected at more than 114 rupees. Bharti Airtel misses street estimates. Net profit in Q1 is flat at 1,612 crore rupees. Revenue per user jumps to 200 rupees from 183 rupees last year. It's not only Paytm. Zomato also crosses a crucial financial Rubicon, declares its first ever profit of 2 crore rupees against a loss of 186 crore rupees last year. Share price jumps about 2% in the last 15 minutes of trade. It's a big thumbs up for India. Morgan Stanley has upgraded its rating on Indian equities to overweight. At the same time, Chinese equities have been downgraded to equal weight, citing evidence that China is at the end of a long wave boom which India is just entering. The re-rating could impact flows of foreign investment, tilting the balance towards India in the coming months.
It's good news for the Indian stock markets, a trigger which could route billions of dollars of foreign portfolio investments into Dalal Street in the coming months. One of the largest research and advisory services in the world, Morgan Stanley Research, has upgraded its rating on Indian equities to overweight, saying it considers India to be on a path of long wave boom. At the same time, it considered China to be at the end of such a boom and downgraded its rating on the country's equities to equal weight. Morgan Stanley raised India to the first rank in its framework from the 6th in its last review, in a report laced with a clear preference for India over China. Morgan Stanley said its overweight rating was based on various economic indicators, including 6.5% GDP growth forecast by the end of this decade. China, in comparison, could have a much lower growth rate. India, according to the report, is on a path of a long wave boom, while China is at the end of one. Morgan Stanley says India's manufacturing sector rallied strongly after COVID. A rapid fade in economic activity hit China, while the capital market in India saw sustained superior earnings per share. China's reported negative earnings revisions and falling profit margins. The report adds that it foresees an upside to the rupee, but warns that weakness in the Chinese currency could hit equities as well. Morgan Stanley cites big supply-side reforms in India for these improvements, while noticing a lack of stimulus actions in China. Other comparisons include an overall macro stability in India versus slowdown in macro momentum in China, the increasing confidence of private equity companies in India at a time when they are trying to exit China, and high household savings in India versus the massive debt burdens on the city governments in China. The report also says that while India was becoming an authoritative voice in global geopolitics, China is increasingly facing global backlash on various fronts. The upgrade is the second for India in the past 4 months. Morgan Stanley Research had upgraded India to equal weight from underweight on 31st of March, citing a resilient economy. The research major has also made specific sector upgrades for India, including industrials, financials and consumer stocks. But the report also warns of some downside risks. including inflation surges and the possible impact of artificial intelligence on services export and labour force. Importantly, the report expects the Sensex to reach 68,500 by December, an upside of 10% from the current levels. Bureau Report, Business Today Television.
S&P Global has projected India's economy to grow 6.7% every year on an average from 23-24 to 2030-31. The rating agency expects India's GDP to reach $6.7 trillion in the next 7 years. Business Today TV Siddharth Zarabi spoke to DK Joshi, Chief Economist CRISIL, about the report.
Thank you very much for joining us. Let me begin by asking you to sort of tell us the key headline that emerges from this report about India's potential economic size.
Well, I think the first big headline is that we expect 6.7% GDP growth per year till 2031, and that will double the size of the Indian economy in dollar terms. Now, this growth is going to be driven primarily by capital, because we have an investment thrust from the government and the private sector is in a position to start the investment cycle, although uncertainty is not permitting a full release of animal spirits at this juncture. The second driver of growth will be efficiency, which comes from the creation of physical infrastructure. Your connectivity is improving and your logistics costs are coming down. So that is a source of efficiency. And on top of that, the digital infrastructure also improves efficiency on the payment system side, on the delivery of subsidies to the masses. And also, I think it's a platform for innovation. So all these together, digital and physical infrastructure combined, I think they create an upside to the growth. Now, I think the only lagging part will be the labor, because I think the labor participation rates are very low. Unless we upskill in a big way and improve the labor participation force, the growth will not be very inclusive in nature.
About venture capital flows, that India is likely to get a higher share of venture capital inflows. Explain that.
Because if India manages to grow fast in the emerging geopolitics, and India, as I said, I think is anyway becoming a hub of innovation because of its digital fast tracking of digitalization. I think all these things create opportunities for venture capital to play. I think there are very few countries where growth is going to be as strong, and India is going to be probably the fastest growing G20 country with this growth rate. So I think it is going to attract a variety of forms of capital, including FDI, venture, etc.
Now let's take a look at how Sensex and Nifty performed in today's trade. The Wall Street continued to remain in bear hug today as headline indices settled sharply lower for another trading session. Selling pressure intensifying in the second half as well. Heavyweight sectors, banking, finance, realty dragging the markets lower. Let's take a closer look. Even an upgrade from Morgan Stanley failed to support headline peers. Sensex was down over 500 points. Nifty was down 145 points at 19,382. Top Nifty gainers today: Adani Enterprises, Adani Ports, Eicher Motors, Divi's Lab and Hindalco. On the downside, Titan, ONGC, Bajaj Finserv, ICICI Bank and Nestle. Catch top market guru Samir Arora on Business Today TV very soon. Send in your questions on the WhatsApp number on the screen by 4 p.m. Friday. The government has restricted the import of some laptops and other forms of computers with immediate effect. A notification by the Director General of Foreign Trade said the import of such items will now be allowed only with a valid license. However, computers, which are an essential part of a capital goods, will not require a license. Also, computers being brought into India as personal baggage will not be affected. The move comes at a time when the government has approved the second phase of the PLI scheme for IT hardware with a budgetary outlay of 17,000 crore rupees. The scheme is expected to generate an additional investment of 2,430 crore rupees and lead to an incremental production of 3.35 lakh crore rupees. The government has said that it does not expect prices to increase because of this move. The Adani Group has further consolidated its position in the Gujarat cement market with the purchase of Sanghi Industries for an enterprise value of 5,000 crore rupees. Sanghi Industries operates the country's largest single-location cement and clinker plant and will play an important role in Adani reaching its target of 140 million ton cement capacity much before 2028.
6 months after being slam-dunked by Hindenburg allegations, the Adani Group is returning to mergers and acquisitions with a vengeance. Early Thursday morning, reports emerged that Ambuja Cement, a company Adani bought a year ago, is in turn buying majority stake in Sanghi Industries. The deal was confirmed by Gautam Adani at 9:25 this morning, who said the move will considerably leverage the group's shipping advantages. He also announced that the Sanghi plant capacity will be doubled to 15 million tons per year. 25 minutes later, his son Karan Adani, in his first such appearance, broadcast the deal on social media platforms, saying the board of Ambuja Cements had approved a purchase of 56.74% for an enterprise value of 5,000 crore rupees.
Our vision is to produce lowest cost clinker in the country at Sanghipuram and then transport this clinker as well as bulk cement through coastal routes to the markets of Saurashtra, South Gujarat, Mumbai and Mumbai metropolitan region, Karnataka and Kerala. Synergies with the assets of Adani ports will help us in implementation of this strategy. With the right implementation, we are very confident that we would be the lowest cost supplier of cement in all of these markets.
Sanghi Industries currently has a cement capacity of 6.1 million tons, clinker capacity of 6.6 million tons and limestone reserves of 1 billion tons. It also has a captive 130 megawatt power plant and a captive jetty at Sanghipuram. Its plant in Sanghipuram is the biggest single-location cement facility in the country. The company has, however, been in trouble with rating agencies downgrading it in June after it was unable to service its debt. The Sanghi deal is the second big cement deal for Adani after it bought Ambuja Cement and ACC last year from Swiss-based Holcim for 51,000 crore rupees. The group, though, is still far behind market leader Ultratech Cements.
With the ongoing capex of 14 million tons per annum and commissioning of 5.5 million tons per annum of cement capacity at Dahej and Ametha in Q2 of FY23, the Adani Group's capacity will be 101 million tons per annum by 2025. Ambuja's goal of 140 million ton per annum capacity by 2028 is well on track. And with this acquisition, we are very confident that we will achieve this ahead of time.
As per the deal, Ambuja Cements will acquire stake from the existing promoters of Sanghi Industries at around 114 rupees per share. At this pricing, the promoters will receive 1,675 crore rupees for their 56.74% stake. Ambuja Cements will also make an open offer for another 26% stake at the same price. For this, it will have to shell out 767 crore rupees. Bureau Report, Business Today Television.
The much-awaited Digital Personal Data Protection Bill was introduced in Lok Sabha today by Electronics and Information Technology Minister Ashwini Vaishnav. The bill seeks to protect the digital data of citizens by incorporating provisions on how such data can be used. The bill prescribes a fine of 200 crore rupees if the data fiduciary or the data processor fails to report a personal data breach to the Data Protection Board and the individual affected. The bill, approved by the Union Cabinet on 5th of July, also seeks to impose a fine of up to 250 crore rupees for failure to ensure reasonable security safeguards. The bill recognizes both the right of individuals to protect personal data and the need to use such personal data by public bodies for lawful purposes. The bill was earlier released in 2022 and has undergone several changes based on various recommendations. Introduced in the Lok Sabha amid stiff resistance from opposition benches who claim the legislation was in violation of the fundamental right to privacy. Opposition members also claim that restrictions specified in the new law would apply only to private entities but not the government. Business Today TV Managing Editor Siddharth Zarabi spoke to a panel of experts on the issue. Here's an excerpt.
Every time I download an app, it seeks a host of permissions, and there is very little option but for me to say yes. That app is necessary. It may be a free or paid service, and it's critical to the digital lifestyle that so many Indians lead. Does this bill do anything, at least the proposals, to make life easier in such a scenario?
Absolutely, absolutely. So I'm going to be giving you a bit of a contrary position from my two co-speakers. To my mind, the bill, and in fact, in significant variation from the draft, the bill actually creates a far more granular regime where data principals or individuals are empowered. Let me use your example because I think it's a great example. When I download an application or I say subscribe for a service, maybe that's easier. When I subscribe for a service, now I will get a much clearer, transparent, easily intelligible notice in any one of the 22 languages which are specified in the Constitution. I will then have the ability to, I will need to understand that notice clearly and provide a clear consent. There are going to be rules around how notice will be provided and so on and so forth. But fundamentally, I will have to provide a clear consent for my data to be processed. The second thing that this new version does, which is a little different from the previous one, is even if I have provided consent for a particular purpose, and that purpose is not necessary for the underlying service, there is language in this bill which may restrict the person from using it. So fundamentally, to Dr. Napanai's point, if I provide consent for service A and it's actually something that's unnecessary for that service, there is an inherent limitation on them using it. Number three, when something is no longer necessary for the purposes of providing that service to me, they are now under a clear obligation to delete that data. Number four, as a data subject, I now have a dedicated authority, which is the Data Protection Board, to whom I can go and file a complaint saying that fundamentally this doesn't meet my requirements. They have not dealt with my data in a manner that I had consented to. Number five, there is a strong set of fines which have been proposed, going up to 250 crores for a violation. And lastly, perhaps most importantly, there's a new provision which allows the government, if you have multiple breaches, to actually block your service and say that you will not be allowed to access systems that you need to provide goods and services in India. So to my mind, it does creates a fundamental new culture around how data will be collected, stored and processed. Yes, the concerns which, where there are concerns perhaps with the language, perhaps things can improve, and this is, this bill will go through the process in Parliament. But I would actually take a contrary position and say this bill is far better than the current position on the ground today. And overall, it is going to have the effect of empowering individuals in India.
Good points there, Pratik. 6 years in the making, and you made points in terms of the concerns. In these 6 years, there must have been God knows how many number of data leaks. And I want to ask you, what does this mean for the average user, given the reality that some of the biggest data sets that exist in India are with the government? Aadhaar, driving licenses, the voter card base, services that we use from the government, apart from telecom, for example, railway ticketing. I could go on, and these data sets exist within the public sector domain. Explain to our viewers, does the exemption for government entities play out on such examples, and how will it work? Because, the point also is that while there is a lot of social media usage, it is optional. You could switch off your social media accounts and live happily, but you can't get away from possessing all the various government IDs. That is with you from birth to death, Pratik.
Yeah, so I think, again, that's where the exemption bit comes in the sense that they still have to notify the instrumentalities which will be exempt. So at this point, it isn't clear which of these, will be exempt from, the conditions that are imposed on data fiduciaries. But that's where the concern remains in the sense.
But Prateek, may I interrupt you? If all of this is to be exempt, and I take your point that the final word on that has not been said in terms of specific exemptions, but if all of this is exempt, then what is even sought to be protected?
Yeah, no, that's the point. So in the scenario where all of this is exempt, then you essentially have a bill that maybe only applies to the private entities, right? Which also with limitations, because again there's the ability to provide exemptions to them as well in certain scenarios, also not to be determined at this stage, right? So as you pointed out, in the Indian context, a lot of our data is already with the state, right? A lot of this information is already a part of a breach somewhere. Already, folks already have access to it, which is why you're seeing cybercrime campaigns are becoming more and more sophisticated. Their operations are becoming more and more sophisticated. They are potentially able to build richer profiles of people for social engineering kind of attacks as well, right? So that question remains, and the bill also broadly then says that look, you have to retain data for lawful purposes, and this varies based on different things, right? I believe in the banking sector you have to keep transaction information for 10 years, right? Or if you go back to the certain directions from last year, which required retention of user logs for 6 months, and in some cases customer information for 5 years,
right,
until after they stop
right,
subscribing to the service. What happens to the right to erasure in that case, right? I may
right,
exercise my right to delete this information, but neither the government nor the private entity will remove that because they are required by other laws.
That's it on the show for tonight. Thanks so much for watching.